Thanks for joining The Deal on Grant Thornton's 2017 webcast, Creating Deal Value Through Performance Improvement and Integration. I'm Rhonda Schaffler, anchor at The Deal. As the private equity market has matured, it's become harder for firms to create the outsized returns their investors have come to expect. Both big and small private equity firms are facing challenges, and today they are placing a greater emphasis on the value creation process. But what's the right value creation model? Some middle market companies are emulating KKR, which has a captive consulting arm that it uses to create value at the portfolio level and in turn create large exit opportunities. Other firms find this model too costly and instead prefer to use a consultant model, while some try to strike a balance between staying in-house and outsourcing. Joining me today to talk about this and a lot more is Brian Patera, Principal Transaction Services, Grant Thornton, Hillary Gosher, Managing Director, Insight Venture Partners, and Stephen Cumbo, Operating Partner, Sentinel Capital Partners. We'd like everyone watching to be a part of today's deal-making conversation. You can submit your questions by just using the right of your browser. Now, let's get started. First, let me welcome everyone. It is great to have you all here.
Thanks for having us.
And always so much to talk about. So I want to talk first with just an overview. It's a new year. What is the state of the private equity world in your eyes? And Brian, I'll start with you. If you could explain the context in which you work in private equity as well.
So Grant Thornton supports private equity in a couple ways. Primarily, we've always traditionally been financial support in audit, tax, and quality of earnings. We've broadened our capabilities to do more advisory services to help clients drive value creation during their deal process, both pre-close and post-close. The deal volume this year has accelerated in the new year. Last year at this time, we were looking for deals and looking at how to support private equity firms. We typically support about 400 deals a year. And this year, going into December, we saw a mass amount of deals that were trying to close before the end of the year, and we thought that was going to be the end of it. And coming into January, we're just as strong as we were in December. So it's pretty amazing.
All right, we're going to get back to that in a moment. Hillary, I'd like your thoughts.
Thanks, Rhonda. So Insight Venture Partners is a growth equity investor doing both venture deals and private equity deals, larger check sizes in the tech industry. So we really are in a growth industry, and as you know, the tech IPO market for tech companies was a little slower in 2016. Only about 13 companies went public, but we have a very strong pipeline going into this year. And even though there's a lot of volatility in the markets and a lot of uncertainty, we're still very bullish about the prospects for IPO market this year.
And Steve.
Rhonda, thanks. Sentinel Capital is a $2.6 billion asset under management fund. We've been around for about 20 years. We enjoyed a really good 2016. We made 6 acquisitions. If you look at the market in general, I think it had over $700 billion in committed capital in 2016. That's up 9% over 2015. And we're looking for a very strong year in 2017 as well.
All right, so let me go back to you, Brian, in terms of that increased deal flow. What do you attribute that to? You thought, just a month ago that was going to be maybe the end of a busy period. So what happened, do you think?
I think a couple things happened. One, I think the elections. I think people were uncertain in terms of how the outcome of the election was going to impact the markets. And as Wall Street seen, we just broke 20,000. I think they were anticipating maybe a downturn, and they wanted to, be ready and prepare to hunker down maybe in 2017. And I think as the elections came through, and some people think it was in their favor from some of the financial implications that it might have, both here in the U.S. and abroad, I think they're just like, we're going to just double down and let's just keep going until something changes.
Steve, would you agree with that assessment?
Yeah, absolutely. Absolutely. I echo everything that Brian said. And just to reemphasize, we see 2017 as being very bright, very active market.
It's interesting, Hillary, when you were talking about the pipeline for tech IPOs, it makes me think of just a few days ago, Cisco came out and bought a company that was about to go public as the first tech IPO of 2017. And they were obviously quite excited about it. They were talking about the fact they were their first cloud-based company.
Yeah, AppDynamics.
And Cisco decided you know what, we want that.
Yeah, so just as the CEO was on the roadshow, his deal team in 72 hours put together an acquisition by Cisco, $3.7 billion. I think that could be a harbinger of things to come. The market for strategic acquirers is very strong. So even as the IPO markets are strong, strategic acquirers have cash and are looking to make acquisitions. And I think you may see more of this. Last year, for example, Hearst Corporation bought Camp Systems. By any measure, Camp Systems not in their wheelhouse. Camp Systems is a maker of aviation SaaS software. Very different, but it's a data play, and there's a sense that Hearst has a much longer time horizon than the private equity market. They can pay up because their return profile or return horizon is just longer than private equity who needs to see an exit. And I think you're going to see a lot of that coming into 2017, which is that in fact it's almost competition against the private equity acquirer because the strategics can pay up and will pay up and are looking for good assets and have a different horizon and hurdle rates. So that may actually impact the IPO markets because we may see more companies, and actually the private equity industry, because we may see more companies being snatched up by strategics than by private equity sponsors.
Does the success that we've seen in the public markets, just in terms of gains and the psychological 20,000, make exit strategies more desirable through the public markets this year?
Mm-hmm. It's an interesting topic. We've seen in the past where public companies have went private and then they went back and the PE firm has taken them IPO. I don't know where that's going to play out. One thing I do see happening though is because some of these assets have been second and third time owned by private equity, that the low-hanging fruit is gone in terms of value creation. So now what I see some of the private equity firms doing is doing a play around add-ons and making a larger corporation out of maybe 2 or 3 small companies that couldn't exist. And now they have a contemplation of maybe I could take it public or sell it as a bigger asset. So I think I'm seeing a little bit of that trend starting to go on. We started to see that kind of mid-year last year, and I think we're starting to continue to see it as they move into 2017. Vertical integration may be one of those things that starts coming back to play, especially with some of the things that we're looking at where they're onshoring assets that we typically had offshored, and maybe there's going to be some benefits from some of the policies that are going to change that.
Yeah. I would agree with Brian, actually. I think that where you've extracted all the value to be extracted through EBITDA maximization,
right.
And then if you're in a kind of low growth, single-digit industry, the one way to juice growth is through M&A, mm-hmm. And there are lots of add-ons out there, whether they're local to the U.S. market or abroad. I think you're going to see a lot more add-ons, which is good for folks like you.
That's
investing.
right.
It's good for you. The business is good because even if you're not helping companies go public, you've got the add-on business to help them grow.
Yeah. Would you agree on the add-ons? Are you seeing similar trends?
Absolutely. We're doing a lot of add-ons in our portfolio companies as well, and I think that market's very strong.
Yeah, a good point, Hillary, is they're doing it for geographic growth, mm-hmm. To reach more areas that they didn't have control of, or that they used distributors or had other reps to get into those geographics and they want to control it. They're doing it for product add-ons to broaden their portfolio so that they can be more to the consumer and get more share of wallet. And then I think they're also doing it for maybe some talent acquisition too, mm-hmm. where the company may be looking for a smaller company or a different company that has some different management philosophies that could bring something new to the organization. So, we're seeing a variety of reasons as to why those add-ins are happening.
So in terms of 2017, and you made reference to some changes in Washington, there's a lot we don't know. There's a lot early on we do know. Would you expect this idea of onshoring or more assets within the U.S. to be more prioritized with some of these companies?
I don't know. I know with the new president coming into office, that's one of his areas of focus. Our public affairs or our public policy and government affairs group has always got their eye on the ball, especially around the accounting issues around tax and what does that mean? I know there's 3 broad issues that they're looking at right now, and it's around carried interest and interest deductibles and the Dodd-Frank Act, if that's going to get overturned. So we're always looking at those. As we start thinking, one call that I've had this week, actually 2 weeks in a row, is our tax team saying, what does this mean to supply chain? What are the changes in supply chain now that we've got this new president in act, and is there going to be a wave of just what was happened 15, 20 years ago when there was a lot of offshoring? Is there going to be a lot of onshoring? And there's multiple things to consider there. Do we have the assets in terms of capital assets to actually do that? Do we have a trained workforce that can actually make those products? A lot of those engineers have had to change jobs and go to do different things in their career. And is there the capital out there to, be had to make that kind of a mass acquisition as we onshore? And then what are going to be the incentives to do so?
It's interesting. I mean, certainly it's something we would not have been discussing about a year ago when it comes to PE.
Yeah, it's interesting on the onshoring. Some of our industrial companies have been looking at onshoring for a while, and we had one company recently that invested over $3 million in a new laser operation to bring work from China back into the U.S. And we've also seen a demand from customers for made in the USA product.
That's right.
And those are in their specifications. There's a certain componentry that has to be made in the USA. So I think that trend is highly politicized right now, but I think it's been going on for some time.
Slowly.
And there's some factors that contribute to that. When people started outsourcing to China originally, there was a big labor differential.
Yeah.
And that labor differential has collapsed, and automation has really picked up. There was an interesting study by, it was in the MIT Technology Review about American productivity and how great it's risen, in fact, with automation. So I think a lot of people are going to be bringing product back in, not so much because of the political environment, but because it just makes sense.
Right.
And
Well, I think that's a good point, which is that even if a product gets brought back to the US, given the automation and given the changes in manufacturing from the time when it was previously outsourced or offshored, we're going to see a lot more automation. It doesn't necessarily create jobs. It might create made in the USA, but doesn't necessarily bring around more jobs.
You're exactly right.
Yeah. So
It was amazing. When I was in China back in the early 2000s and I was doing some electronic offshoring, walking into some of those plants and looking at the investment they made in capital and how clean those facilities were, and my impression was I was going to be walking into a dirt floor factory with a lot of people doing the work. They actually had a lot of sophisticated automation there. I think the interesting thing now is, do we want to reinvest in that capital and bring that back in? Because those are large capital investments depending on the size of the company. And can it ride the wave, or is this just one of those blips? And how much capital do you want to really invest in that
well,
company?
a lot really depends on the tax differential between
Exactly
the
right.
incentives to keep it offshore to bring it back on.
That's right.
And the difference in tax differential, in any one jurisdiction versus the other is probably 20-25% between a 10% tax rate and a 30-35% tax rate. But if you take a look at any single industry, the delta between the best in that industry and the worst in that industry is probably also 20, 30, 40% sometimes
Right.
between the top performers and the bottom. So I almost feel like, it behooves you to look at the industry that you're in and, choose the worst companies and optimize them and not worry as much about what's going to happen with tax. Because, you'll make decisions when that happens, but in the meanwhile, there's so much optimization to be done that probably drives more value.
Right.
I think one thing that was pretty interesting both were interesting, but one thing that Brian was talking about was the large tooling investment that was initially made in China. And, the requirement now to retrofit that equipment and invest in it. And you can see it in terms of non-conforming parts. If you have a stamping press and the dies, and those are getting worn out, over the past 10, 20 years. And some of the presses we have over there are ancient. Whether or not you're going to invest, multi-millions of dollars over there to refurbish that equipment or do it over here is a pretty interesting choice. And I think in many cases, you're going to want to do it over here.
Yeah.
Well, in many cases, the intellectual property around creating the new technologies has always been resident in the US. The manufacturing's just been offshored. So that intellectual property still exists here. And if there's better and more efficient ways to do it and cheaper ways to do it with the new technologies, it behooves people to do it here.
Absolutely.
Well, I think we traveled the bubble too, right? We thought China bubble was going to be 20, 30, 40, 50 years before we hit the max. We've hit the max with the labor market over there, right? And now people are actually going outside China, where China companies have invested in, companies in Jordan and Africa and Vietnam and Cambodia. So they're Chinese owned, but they're actually manufacturing. They're trying to look for lower cost labor. Well, guess what? Everybody's starting to move in those trends. So guess what? Now where to go? Why not come back home? We've got people that we have to give jobs to. We have opportunities, and I think you're right. You're at the right trend of recapitalizing. Why recapitalize there versus here in the U.S.?
So does that put a premium valuation potentially on some companies that might fit that bill? In other words, if everything is equal, but company A is here, is it worth paying up for, as we've seen companies pay up for assets in the past?
I think it could be an interesting consideration, thinking about the way they're trying to create value and how they're trying to grow these companies. I think it could be really interesting to say, here in the US, if we make that investment and we grow the workforce and we have a shorter supply chain and we can get more serviceability to our customers, because still in China, you have to be 90 days out. And your forecast could change in 90 days. So maybe we can be more attentive to supply and demand needs. We can manage our working capital a little better and make that capital investment in order to satisfy the markets and the customer demand. But I think it's got to be a play-by-play, industry-by-industry look.
I'll give you one example. We have one company, an industrial company, and they recently won a contract. It was about a $25 million contract, 6-year contract, but the requirement had to be made in the USA.
Right.
So I think, everything you said is spot on, but I think there's going to be also customer demands that are, if you're located in the USA, you can conform to those customer demands easier than if you're over in China.
Yeah, I mean, what we're saying is that in spite of the kind of uncertainty and the volatility that exists, by any measure, this is a business-friendly administration that's come in, between Mnuchin and Cohen and Wilbur Ross, there's a very business-friendly administration. So
That's
I think
right.
that you're going to see, regardless, it's a good environment for private equity and for business.
One thing that might change this year, and we talked about this a little bit before we sat and had our formal discussion, is you look at a diligence process that every year gets more sophisticated and certainly is done well. But we discussed the diligence toward human capital, which feeds into this discussion a little bit, which might not have been the first on the list, perhaps. Maybe it was looking at technology. How might this evolve and change in 2017, the diligence process and looking more closely at items that perhaps were lower on the list?
I can answer that from a tech perspective, given that's the world that I live in. But certainly when we've analyzed our returns over the last couple of years and just what drives performance, yes, we have certain plays and certain activities that we do that both help grow on the top line, because tech is very much a growth industry. So it's around how do we drive additional growth as opposed to some of the manufacturing, which is more how do you drive margins on the bottom line. But the ability to execute is such a key factor, and the input of your capital as an input into success, human capital as an input into success is to us critical. And so having the right talent who can execute, I think, is something that all private equity companies are looking at much more fully, not just in tech but everywhere. Tech is particularly important, not just because you need the execution at the senior levels, but the input factor on having enough engineers and being able to bring those in on H-1B visas or on kind of visa waiver programs. That's a key component for tech and the ability to grow and produce software in the US. So, for us, anything around immigration may land up being a factor that we need to look at. Mm-hmm.
Yeah, completely agree. I actually, my undergraduate's in the STEM profession. I have a lot of friends that are in that profession, and they cite all the issues that you talk about, getting H-1B visas, people coming here to the States, getting great engineering training, but they can't stay here. So an issue we have to address. But also on the human capital side, we've always, at Sentinel, viewed that as extremely important. I think everybody would agree that if you have a solid management team that can work well together, that's probably the better predictor of success than virtually anything else. And we take that very, very seriously, and I think we'll continue to take it seriously in 2017.
Yeah.
You really can't create value without that.
Yeah, I would agree, Steve.
Absolutely not.
We spend a lot of time on human capital. We actually have a human capital practice at GT that we formed just because we were getting more requests around looking at the human capital, and not only at do we have the right size of a team, but what's the team's capability to perform, and how quickly can they start moving in a new private equity-owned environment when they were potentially a family-owned company, and now that there's going to be new rigor to them in terms of the expectations on performance. But one of the things I always caution the private equity firms on is, you may fall in love with the guy and he's a great guy to go have dinner with and a drink and might have a real good expertise on it. And look at their past performance, and it may have been good. If in the due diligence process we find, millions of dollars of new EBITDA that we can create, I question to them is, why hasn't it been created in the past? What's been the roadblock for them?
Right.
And do they have the motivation and the capability to take it to that next level? And what is their payout at the end of the day? You know, they may be getting a very nice payout after this transaction's done based on who the ownership is and what their part of the deal is. What's their motivation to continue to move forward? So we're really always assessing not only their talent and their capability, but what's their real motivation to move forward and really drive new value for you as part of the leadership team.
That's really interesting. You know, we evaluate executives individually, and we put them through a battery of tests and all that kind of thing. But I was talking to a service provider yesterday that they take it one step farther. They evaluate everybody individually, but then they evaluate how they would work together as a team.
Yeah.
You know, recognizing that this person may have this disc profile or this disc profile, and how likely is that team going to gel?
Function well together.
That's right.
Function well together.
Yeah.
And they were talking to me about some case studies that they had done for some very, very large private equity firms, where they predicted that based on the personal characteristics of these individuals, although they were each great talents in their own right, they couldn't function as a team. Unfortunately, that prediction came true. So there's a lot of science and technology that's going to go into human capital.
You know, from the tech investor perspective, we're seeing so many human capital software companies emerging, doing everything from performance management to initial assessment to ongoing employee NPS scores, you know, net promoter scores to understand employee engagement and things like that. And I think that just really reflects the environment that we're in, which is that people recognize that the scarce resource is talent and capital, you know, human capital. You know, because it's not just at the executive level where you know, execution really matters, but it's have you hired the right people into the right jobs?
Yeah.
Yeah.
And you know, we're seeing companies, our own included, starting to think about assessing incoming salespeople. You know,
Right.
do I have the right sales talent? You know, do I have the right developers? Do I have, you know, the right people with the right marketing capabilities? And so, at every level of the organization, there's a sense of I need to have the right people in the right jobs.
Well, we're at an interesting time too, right? I mean, the millennials are moving into the workforce, you know, at a huge pace. Their expectations in work is much different than our expectations in work, you know? And so how do you manage that? You've got two workforces that are all trying to do something, create value in a much different way. And we're trying to modify to them as they're bringing technology in new ways and sometimes a more lackadaisical work environment. And we're fast-paced, you know, pull up your bootstraps and go get the work done. And we're managing that, and sometimes that's an interesting, you know, analysis that you made. We're doing some of those same studies, like, you know, in a very tech workspace where, you know, you want the college graduates, you want that new technology coming into your business that's run by, you know, a guy that's in his 50s or 60s who
Right.
didn't work in that environment and is a great leader of the organization. How does he manage those people? And having that answer and putting a program together that keeps the organization going along and creating succession plans is really important.
Well, I try to think about, you made some reference to in technology how you view things, and it's different than industrial. And I was thinking, actually, now isn't industrial trying to become technology? There's got to be
absolutely.
some add-on acquisitions to get that software and to get all these technology components that
Right.
you know, maybe a traditional manufacturer might not have had. So would you say in some ways that add-on technology is every industry, whether it's manufacturing? I mean, that's got to be one of the
Absolutely.
big drivers for value creation still. We're still well at the start of that ballgame, aren't we?
Data is important. I mean, making decisions based off of data. Just look at what happened in 2008 with the economic downturn. A lot of the companies failed because they didn't have data. They couldn't react quick enough based on the change in demand or the change in supply. They had stranded capital sitting out there. They didn't make cash flow decisions because the data wasn't available. And I think you've seen over time people invest more in ERP systems and their technology. I got manufacturing floors that have iPads out there that the supervisors are watching. What's productivity? What's OEE? You know, oh, we've had a downturn in orders, so we better slow back the labor. So they're trying to get closer to the demand curve so that their supply matches it, because why waste? It's a lean concept. Waste is
Right.
cost. So the closer you can get to your supply and demand equaling each other, and you can only do that with data and technology. So I think there is this really good intersection
It's a
right now
convergence.
where people are really looking at technology, look at social media space and how we're looking at that for, you know, growth and acquisition of customers and how we're using it in manufacturing. And just, you know, I'm married to my iPhone on a daily basis.
So as opposed to a PE transaction where it's a manufacturing firm A looking at smaller manufacturing firm B, that's not going to be what you need to bring to the table.
I think that's a part of it, but I think there's more to it. You know, what is the creation? 1 + 1 can't equal 2. 1 + 1 should equal 4 or 5. And if you're not thinking of the transaction that way, Why are you making the acquisition?
Steve, I think his math is wrong. What do you think? One plus one. You can explain what he means by that, though.
Yeah, no, I mean, the classic thing that you have to
He's an
get
accountant.
Actually, I'm an engineer and an accountant.
So I know what he's trying to say, but I didn't think the math added up there.
It does.
But it is, I mean, it's not so clear cut, I think, now, because that value creation through technology is different than saying, I'm going to get a second plant here and we're going to combine resources and then output is,
Absolutely, and to your point, on data or an ERP system, if you're going to really leverage that, you have to have good data. You have to understand. People do SIOPs, sales integration or sales inventory and operations planning integration to match supply and demand. There's a lot of heavy data investment in that, and I can see that you would have a manufacturer that would identify a firm that was extremely good at sourcing or had some other technology play, and if they put them together, they had something that was much more valuable. I think all those things are possible.
Yeah, I think a good example actually is several years ago, Amazon bought Kiva Systems. And Kiva Systems were the little robots that are in the warehouse that go and pick up stuff in an automated way. Now, they could have just licensed the technology as most manufacturing companies would do, which is licensing, warehousing technology. Instead, they bought the company because they saw it as a competitive advantage in terms of their ability to deliver quicker. And I think you're going to see a lot more like that, is the buying of technology that provides competitive advantage, whether that's in supply chain or warehousing, things like that.
I couldn't have said it better. That's
So
exactly.
I want to step away for a moment because we're touching on all sorts of great ideas, and it really makes you think that 2017 will have a lot of differences in them in PE. Brian, I want you to spend a little bit of time talking about the study that Grant Thornton did on value creation models. Because while there's some similarities to what companies need, actually the model is different. So let's delve into that a little bit, what you found in terms of different PE firms using these different models.
Yeah, so it was interesting. Back about 6 months ago, we were all sitting down just contemplating, how are we going to continue to support PE? We traditionally supported them in quality of earnings and tax. And we'd started to build a group that would support them from a value creation on the operation side. And before we really launched into that, and we had a team of 8 people that initially started, how much should we invest in that? So, a 92-year-old accounting firm have to go do a study and start, looking at where the opportunities are and should we really make this investment? And so we did. And so we started with several firms. We went to KKR and started interviewing them around, what are they doing with their captive consulting firm? And how much is that, do we see, proliferated across the PE firms? And what we found was pretty surprising, that there was a mix around what we saw out there. A couple of things came out of the study. One, we saw that people were looking for the right talent to bring to the deal to advise them, whether it's internal or external. The other thing they looked at was, everybody assumed that everything's looked at as kind of a captive deal, but there's many ways to finance a deal. And, as we're advising clients, we're seeing different ways, but, certain firms have their priorities on how they're going to finance the deal, but we saw a variety of ways of doing it. So that gave us, we have to be flexible in terms of what we provide them in terms of how they want to support value creation. The other thing was there was a mix between operating partners and non-operating partners in firms. Some people, I don't know what you do, Steve, in your firm, if you have operating partners in certain sectors that help the operations post-close. We found some firms that are really heavy with operating partners, and then the operating partners either go outsource consultants or they actually do the work, versus mid-market companies that don't even have operating partners, and they really supply that need through service providers. And then the last component was, they're driving value creation much earlier in the deal than, when I first supported PE back in, the early 2000s, they were thinking about value creation. After we close, we'll figure that out. Today, they want to know that before they close, and sometimes we have 2 to 3 weeks before, they're signing LOI and they want to close the deal in 30 days. They want to know exactly what the...
It's part of the investment thesis.
What the investment thesis is, and how can I leverage that potentially from a financing perspective. So it's much earlier in the process. So now we've grown our practice. We've got, 3-4 times the size of people that do this operating assessment to help identify value creation in a deal, both on the corporate side and the PE side.
Interesting. So how does your experience dovetail off what Brian was saying?
I've seen it more and more. I'm a member of one of the operating forums, or PE Open, or that kind of thing, and we're seeing it more that operating partners are getting heavily involved in the due diligence side. They're bringing in service providers. In order to be competitive, we have to find ways to to get value and then underwrite that value in a deal so that you can justify a higher multiple. Multiples are very, very high right now. So there's a lot of focus on that. Yep. For us, we're pretty conservative when it comes to we'll look at those opportunities, we'll spec them out. We do have a number of operating partners, and we rely on a number of service providers. So I think our model is probably closer to what in your study was, I think it was the Carlisle model, where they had different groups of people that address different things. We have our luminaries that we put on boards. We have our operating partners that are working out there with the portfolio companies. And we have a strong selection of service providers that we can call to address a very specific need, whether that's lean manufacturing, setting up a distribution center, or something like that.
Hillary, how about your experience?
Yeah, if you think about the fact that the multiples are high, since the valuations are high, you're not going to really get multiple expansion as part of your investment thesis. And since financial engineering, debt has been fairly cheap, which means that people have put a lot of debt. So which is great. It's a way to juice the multiples. But the only other way that you're going to get any value is through operating leverage, and really driving that, which is why the emphasis has emerged around making sure that you understand how you're going to get that operating leverage very early in the process. And so many of the operating teams are engaged in diligence right up front, helping to define the investment thesis and exactly what the levers are that you're going to pull post-close. And most of those levers are being put into place even before post-close. And there is, to your point, a sense of urgency. We get going, immediately after close on the 4 or 5 priorities. And so at Insight, I run a team that has a significant number of people. Now it's easy for us because we only invest in software and technology, so it's easy to have a set of experts who have sort of been there, done that on the playbook when it comes to marketing excellence or sales excellence. And so we bring them in. We have our set of best practices around how do you sell technology effectively, how do you market technology effectively, all the way from the funnel through to close. But we still leverage operating partners who are senior executives who work on the deal, and we still leverage a network of folks, including consultants. So I think it is a hybrid of, I think the common theme though is that everybody's putting that kind of operational optimization front and center.
Yeah, that rigor is really important. And we see it in multiple models like you do, Steve. Some of our clients just want quality of earnings work. Some want a multiple, they want a menu of options. Like, how's the quality of earnings? We want the tax, we want a manufacturing assessment, we want a supply chain assessment, an HR assessment, an IT assessment. Some buy the whole packet. It just depends on the deal and who and what they think is important. And sometimes, we're working for a client and, we've sold the full package to one deal, but the next deal, HR isn't so important, so guess what? They only buy several of the other things. But I think we've grown and matured as a firm and that was part of the study, was to say, hey, where's the PE market going and what can we do to continue to support this middle market PE? And let's align with them. So we're continuing to stay in touch. We made some really good contacts during the study, and I think it's going to continue to be one of those things that we continue to research and continue to evolve.
It's interesting how the process has changed, I think, when you talk about everything earlier. What else has changed in the actual process?
There's a lot more rigor in my industry, at least around the metrics. So, I'm not as familiar with the manufacturing world, but certainly in the SaaS world, there is a set of specific metrics around customer acquisition, lifetime customer value, the NPS scores, and, we're making sure that we can stack rank all the companies, even during diligence, against those metrics to understand, look, how does this company fit in terms of good, bad, or ugly, and therefore, what would be the things we'd need to do afterwards, but also whether we should make the investment or not. There are certain metrics that have emerged where, if the customer lifetime value is not seen to be positive over a certain period of time, or the payback period in which you can justify the cost of customer acquisition is not, under 12 months or, within 12 to 15 months, you start to question the business model. And so as a result of bringing those metrics in, you're both more rigorous on the back end, but the front end on diligence as well.
Our diligence process used to be based on, years ago, more peer study work, and looking at metrics. I think we've evolved a little beyond that, especially in the manufacturing and consumer goods space. Now we're looking at not only the peer study, but we're digging in deeper in certain areas. I'll just give you a great example. We did some work for a private equity firm that was making an investment in a grocery market. And of course, who hasn't seen a sim with a hockey stick trajectory of both EBITDA growth and sales growth? And we started looking at that, and they said, we will have all this expansion opportunity. One of the things we looked at and said, but look at where they're riding the wave. Food prices in meat and vegetables has been going up continuously over the last 3 years. Guess what? They're just riding that wave and projecting it. Have you seen what meat's doing lately? It's starting to come down. So guess what? In grocery, meat is a value that's actually, a markup to the consumer. sales is going to start going down. Profitability is going to start going down. So think about some of the economic factors and dig deeper than just looking at what the sim says.
Yeah, margin growth or unit growth is so much better than growth via pricing.
That's right. So that's what we did.
Pricing
Yeah.
leverage is exactly that, but actually how to get more unit growth.
That's right. So when we started talking to them about foot traffic, how much foot traffic has actually increased in these grocery stores? Has it really accelerated? There's a better lever than just looking at the metrics. That's a metric that drives what you're looking at. And I think that's one of the things that we help advise the PE firms on is, as a person that's been in industry and worked as in different areas of supply chain and manufacturing, if I were the CEO or the COO of that company, how would I look at it? And not hide the numbers from the PE firm, but really talk about where are some of the blind spots that you're going to have to consider once you own this asset.
Right.
Steve, any thoughts from you on that?
Well, I think we kind of meld both approaches because we focus on sectors that we have a lot of deep expertise in, and we can understand what those metrics should look like. And in your example, if certain things don't go this way in a restaurant enterprise or a quick service restaurant, it's not something that we want to pursue. So, we tend to focus on areas that we've done well successfully. In areas that we know and that we've had years of experience in. So we're very focused on the analytics, very focused on the metrics. We have certain defined diligence streams that we go after and have to hit. But I'd like to think that we also have that little bit of industry expertise, and we're very disciplined in our process, that we don't go outside of that.
I'm glad you said that word, discipline, because we haven't gotten there yet. There's always a disciplined approach when it comes to PE. Has anything changed in terms of the approach to discipline? In other words, valuations are higher now. Does that change a disciplined approach? Does that make people more excited? Does it make them more nervous? I'm trying to figure out how people can get steered off course potentially. And everyone talks about discipline when it comes to due diligence,
right.
But I feel like, why are we always talking about it? Why isn't it just ingrained and never an issue? It does seem to be one of these issues that kind of surfaces.
I think, a transaction is sexy, and people fall in love with a product or a product line or a logo. And,
or
it's
what it can do for them to take their company in a different direction, whether
That's right.
geographically or product-wise.
That's right. So, they get enamored by it a little bit, and then they start down the process, and they get so invested, the sunk costs are there. Do I want to turn back? Can I go fix it? And they're always weighing back and forth on that discipline. One of the things that we always try to help drive the clients there, I know you're thinking about close, but let's talk about exit, and let's plan for exit right up front, because your investment thesis plus the investment you want to make in this company should align with you getting to your 3, 5, 10-year exit. It depends on how much you want to invest in capital, IT systems. What's your trajectory for this company? Are you going to sell it off as an IPO? Are you going to go sell it off as an add-on to another company? Or are you going to go just put it out into the market for a strategic or another PE buy? And so having that lens helps us let you look at the company in terms of what are the things that we could activate, those levers you could pull, so that you're making the right decisions at close, and then you have a plan so you can start activating those levers day one.
Right.
The interesting thing about discipline, and it sort of builds on what you were saying, is that it's hard to be disciplined when you don't have a lot of deal flow.
Yeah.
If you have a lot of deal flow, you have a lot of options, and you're not just all eggs in one basket. You're not just committed to one company that you've spent a year courting or getting to know. So I think it's incumbent on private equity firms to make sure that they have a lot of options to put money to work, because there is a lot of money that's resident in PE firms. So there's a lot of capital overhang that's dying to be put to work, and so that's when you get undisciplined, if you don't have sufficient deal flow.
Yeah.
So this year we have it, though, so that shouldn't be an issue.
Well, that's true, and I would argue that if you don't have sufficient deal flow, that you should, stick to your discipline and sit out.
That's right.
And just continue to focus on what you do right, and don't lose that discipline, because that discipline is what made your firm successful. And you got to stick to it. So,
Is it more of a problem in technology? I feel like the technology changes so fast too, that's another issue. Waiting to see that payoff It could be
In the
different.
last, 18 months ago, I think it was more difficult to be disciplined because we had a lot of different types of investors, institutional investors, who were finding it hard to find growth in the market, and so were putting money into private equity or into companies that would be traditionally private equity businesses and driving up prices. So, the Fidelities or the T. Rowe Prices were taking rounds in Uber and, in some of the quote-unquote unicorns. I think they've pulled back a little because what the companies who were accepting the capital have realized that by taking that kind of institutional money, there was a lot of public disclosure that they weren't ready for because they weren't yet ready to be public companies. They were still very much private companies and were still losing money, and the metrics weren't all in order, and they, still experimenting with how to get a business that worked. So I think you've seen a bit of a pullback, and as a result, it's now easier or less impactful because we have more disciplined tech investors who understand the business as opposed to some of these outsiders who I don't think fully understood what they were getting into.
I think the fact that companies are taking the lens of value creation says that they're becoming more disciplined. Think back years ago when it was more like a fund manager where, yes, you had the deal flow, I'm going to make some investments and I know I'm going to come out with some kind of average return, I'm going to have some good winners that I'm going to pick, and I'm going to have some people that are at the middle of the line, I'm going to have some losers, and guess what, at the end of the day, the fund's going to return. Today, I don't think people are putting up with losers, and they're going into it with, I'm going to do everything I can to create value in this company, or I may pass on it, because guess what, being below the line isn't acceptable today. I think the investors in the portfolio are not, they're looking for a higher return, because they're looking for something differentiated.
Another point on that is that to your question around, if the emphasis on operating partners, is that for the LPs, it's become table stakes.
That's right.
So in the old days, if you could buy well bought is well sold, and well financially engineered is well sold, and you made your money through those kind of things, and the value creation plan came later. But capturing that value early on is really, you need to demonstrate that to the LPs in order to raise capital. And so having an operating set of partners or a strategy, a methodology around which you create value is table stakes when it comes to raising funds.
That's right.
Yep.
On the cost of capital, interest rates should be going up this year, at least that is the forecast now. Does it really change in terms of the financial side of things?
I don't really have a view on that. I don't follow the debt markets that closely to answer that question. So.
It's nominal increases, though. I mean, how much are we seeing through debt? How much are we seeing through cash? You see anything changing in the ratios?
I think it depends on the PE firm is what we see as we kind of address back, even in our study. We have those that, are more captive. We have those that are doing co-investment. You see a lot of private equity firms co-investing in deals, or where they both own, a company, and they see that they have some synergies and they want to keep a stake in that investment, and they put them together. So now you've just done an integration of two PE firms that own the same. I think it's variety, especially in the middle market, and I think it's whatever the firm is comfortable with in terms of what their thesis has been in the past. And again, I'm kind of like Steve. I don't get into that debt market component of it. We just kind of see it from the side.
What would change the rosy view of PE this year, the deal flow?
Wow. I think an economic downturn, starting to see scarce resources. I think if imports start going down and we don't have those resources available to us, or there's a dramatic change in available cash in the market, would change things pretty quickly.
But it doesn't seem like any of that is on the horizon.
No, I don't think so.
Well, you have seen some of the turnaround firms are actually accelerating hiring. We've been in a growth situation now for close to 8 years, and that's unusual, and it should come back down. So there was an article that came out from a friend of mine at Ernst & Young about how these firms are actually staffing up. And if you look at the turnaround business, it really fell off, and it was at its very low point here for the last few years. And we could see that pick up pretty quickly.
Yeah. I mean, when is that trend going to stop, right? Do we have another 3, 4, 5 years? What goes up must come down. We're kind of poised in both ways. So most of the team members we have can flex in both ways. So that's what I did back in 2008 when the economic downturn happened. I was doing all performance improvement and all value creation. And the second, they're like, hey, if you can fix it, can you salvage it? So some of the skills are really transferable. I don't see our firm, adding resources in that area on the turnaround markets. I mean, we've got a restructuring practice, and there's some stuff out there that they're working on, but it's not where the acceleration and growth is today. We're poised to move in that direction, but I think people are just kind of waiting and seeing still.
Yeah, I don't think that certainly the debt markets and that are going to make that much difference to the way people approach acquisition or hiring companies. Where it may make a difference is on recapitalization. You know, one way to juice IRR is to recapitalize early. And you know, if the debt markets are either have more strict covenants or the price of debt is higher, you may just not see that recapitalization. So it may have a long-term effect on IRR.
But it's been covenant light for a while now.
Yeah, has been, which is why you've seen some of the exuberance and you've seen multiples increase and valuations go up.
I just don't know what would change that, though. Why would things not continue to go on as covenant light, at least for the near term?
Nothing in the near-term horizon, but there's a lot of volatility in the market and a lot of uncertainty with, what's going on with Brexit, what's going on with some of the new European elections that are coming up, with what happened, in the US, and we don't quite know all the deregulation that's about to happen and what the impact of that looks like. So I think there's a bit of a wait and see of a lot of people, but there is a sense of something could happen. We just don't see it yet.
What does deregulation that can create opportunities in the public markets mean for private markets? Is it similar? In other words, we'll see a big deal announced. We'll saw a healthcare deal that likely is not going to go through. Does it impact the way anybody in the private equity space thinks as well in terms of what they are pursuing or looking at?
I don't think so.
It's easier for smaller companies to list and go public. The Jobs Act, made that kind of, you can list under the radar. Some of those earlier companies, you may see more of them going after public market capital, both for the prestige, but also because it's a way to access more capital. So I think that could be impactful, but I don't see, to your point, that there's going to be that much impact.
Yeah.
Well, it's interesting that you mentioned Brexit, because we have, some companies that are in the UK, and at one time we thought it was going to be a big impact for us, or we were kind of hesitant about it, but so far it's really that the pound's dropped from 155 down to 125, and we haven't seen anything, other than that dramatically change in the UK. It may over the course of the next 12, 24 months, but a lot of these things that happen, there's usually quite a bit of a lag until they come into play. Even when we're talking about tax strategy and tax planning, the 1986 tax bill took 2.5 years to implement. Right. And I can hardly believe that any tax plan that the current administration is contemplating today can get done in 200 days. I mean, we're in a more adversarial environment today than in 1986. So a lot of these changes are things on the horizon, but there's just so much uncertainty, and it may drag out for many, many years.
And things have to get done between now and then.
Exactly.
A lot can get done in 2 years.
In the meanwhile, business as usual in a sense. Until otherwise.
I've seen more international deals hit the table in the last 4 months than I think in a while, repetitive, where they're making investments to buy companies that are either like products or expanding regional marketplace that Brexit, they don't even care about it. They're just, hey, I want to be in that market. It's an opportunity to expand. And I think the FX rate has helped them kind of make that decision that it's in their favor.
Integration harder in those cases?
It is actually harder on all aspects, especially in the human capital side when you have two culturally diverse companies coming together. European way of managing companies is much different than the U.S. We spent a lot of time bringing change management and culture to the deal. It kind of goes back to that human capital part. Right. You got to look at the deal holistically, not just the financing of the deal, what the growth of sales has been, what the growth of margins have been, or profitability. But guess what? What's the sustainability and the long-term growth of this company? So we spent a lot of time working in that area.
How are the standards for numbers different when we talk about the rush to get value creation going early? Is a 5% improvement in operating margins, and that's probably high for a lot of industries, no longer the norm. It has to be 6%. It was 5% 3 years ago. So I'm trying to get the sense of pressure, I guess, when these deals get done, that it compared to, say, 5 years ago.
Yeah, so I think we look at it from a third-party point of view. We tell you what it is. Steve can probably tell you how it's pressured them, but we're always looking at where are those, again, if you look at the exit strategy and where you think you want this company to be in 3, 5, 10 years, here's what we think from operators you can create value out of what you have today. And the return is what the return is. I think it's the opportunity for the PE fund itself to kind of make the decision, is it within our tolerance level of the right growth trajectory, and are we going to get out of this what we want?
I think there's been a fair amount of emphasis on operational improvement, over the past several years. So I don't think you can expect the same gains every year. You're kind of getting to that knee of the curve on some of that, but I think people are focusing a lot on revenue growth and revenue strategies, and how do we? Because cutting costs is easier, right?
Right.
More
what
measurable.
Do we, more measurable. What can this? The real game changer is being able to grow sales.
Yeah, and that goes to sales excellence or sales efficiency and understanding the metrics and using technology like Salesforce.com or like Marketo, technologies that help you understand the pipeline of sales to close. But the other point there is that often management, the existing executive team reaches the limits of what they're capable of. And that's where, the faster that you change out management, the more the sacred, they take a look at the sacred cows and they're like, this doesn't make sense. I wonder why we were doing it that way.
That's right.
And so there's a lot of impetus among private equity firms to say we should just change management irregardless. We may have a good management team, but, irregardless, bringing in new managers is going to uncover stuff that the other folks didn't think about. So that's one way that I think people feel that they could, increase the margins is by just having fresh eyes.
Mm-hmm. I think a lot of it's data as well. We talked about technology early on, and if you're going to grow a company's revenue, you really have to understand what that revenue engine is, how it works, and in the market in which it plays, right? So once you understand that, and you have the data, and you've done the analytics and all of that, then you can start looking at what your products are, how those products can be blown out across different customer segments, how those products can be blown out across different industries, and really laser focus your growth strategy. So we're seeing a lot of people really focusing on the data, because the answer is going to be in that detailed data, and the critical data and critical detail.
This is why big data just became, the phrase of the moment, and
That's right.
those technology companies that can supply that are.
Well, you have some really interesting technologies like ClickView. We've used that in a couple different
That's right.
locations that can grab data from different databases and consolidate it. A lot of that is absolutely terrific stuff, and I think people are going to be making more and more an advantage out of it.
And the interesting thing about those tools is that whereas before they were in the purview of the IT department, they're now in the purview in the hands of the decision maker, the actual
the
business
operators.
user, the analyst, and so the data is being made through the use of technology that much more accessible to normal line managers, as opposed to like, oh gosh, I got to get a report from IT and they got to get it into the data warehouse. Now, it's at your fingertips. Tableau, Click, a lot of these companies have made it very easy for people to make real-time decisions, in their own environment.
I'd like to go back to the growth and revenue. What we're seeing in private equity is we're starting to see companies add on and merge. And why didn't they do that in the past? I think as the private equity professionals have become more comfortable with that. They were investment bankers, right, that turned into this market and into this profession, and they were used to looking at the financing of the numbers. As you get into the value creation, now you feel a little more comfortable that you know the operation, and what does it take to meld the two companies together? So integration was always one of their concerns. I can't put the two companies together because then I'm going to have the model of 1 + 1 = 2. And when we have to do 1 + 1 = 5, how are we going to cut some of the redundancies of operation? How are we going to drive margin now that we've got economies of scale, we've got further reach out into geographics? How do we really take this new company? They're still looking for partners to help them on the integration side. It goes back to the culture. It goes back to, how do you run this company that used to maybe be a $100 million company, and you have a management team that knows how to operate that way, but all of a sudden you're a $250 million company. It takes a different lens and a different management style to operate all of a sudden a double size of the company that has broad geographic reach. So I think, it's more important now that they understand that, and I think they're starting to feel more comfortable because they understand those value creation levers, not just revenue and margins. They understand the in-between of what takes it to work for the company to actually work.
I think that makes technology even more and more important, because when you're evaluating a company, and a lot of times it's going to be a situation where you're going to buy a company as a platform and try and build onto it. And you really have to understand if that technology in that company is scalable.
That's right.
Right? Can I make that acquisition? How easy is it going to be to integrate somebody else? And the companies that have better technology platforms, maybe it's online ERP systems or something that's much easier to plug into. All that becomes a real thing that you look for.
Yeah.
Yeah.
We just did one where we've got some, one of the areas we do is IT assessments. So, we go in and we evaluate the IT system around ERP, and, some of these smaller companies are still running on QuickBooks, and they really don't have sophisticated ERPs. One client, they're looking for the next add-on that's going to bring a more sophisticated system, because they're saying, this is a $40 million business. We're not going to go invest in an ERP system. We're hoping to go make a $100 million acquisition and then bring that part of it. So you're right. They're looking for those assets to bring, more sophistication, because why would you invest in an asset in IT for that size of a company.
Well, and in the mid-market, given the cloud access, the cloud software, you can rent the software,
Yeah.
provided there's not that much implementation and
Right.
customization, which of course
Yeah,
there could be
that's
in
the
any
part,
industry.
right, yeah.
But you can access technology fairly inexpensively compared to how you used to do it in the old days when you needed to buy SAP and spend 3 years
Sure.
implementing it.
That's right.
You know, now you can get NetSuite online and you
Yeah.
can be up
Yeah.
and running with
Yeah.
an ERP system in no time.
That's right.
When you've worked with individuals and let's say a transaction did not work out as well as planned, either on the number side or it wasn't the right fit, what's the biggest reason why? Is it technology or is it human?
People,
People.
Absolutely people.
always people. Execution is key. I mean, we can have the greatest laid plans. We can have our 180-day, plans of action items. We could have, a chief of staff or an analyst managing people to the.
That's
And
right.
if it's not executed, you don't get.
And that hasn't changed. It hasn't
that's
changed
not
for
ever
years.
gonna
It's not going to
change.
change in
Yeah.
2017. either.
Luckily, people
No.
are still needed, even in the
That's
days
right.
of robotics. They can't get rid of us.
It sounds weird, but this is a people business.
It is.
And everybody will tell you that. So.
So we only have a couple minutes left, believe it or not. What I want to do is kind of go around the table quickly and just think of some sort of prediction about 2017 or something that will be a trend to watch in 2017. And we've talked a lot about them here, so you can just think about it and sum up your thoughts that way. So Brian, I'll start with you on that.
I think 2017 is going to continue to accelerate. I think probably by mid-year we'll see just a quick pause to say, are things going well? I think people will take a look at public policy and some of the things that may have changed based on the new administration, and then bob and move based on where that goes. We're predicting a strong outcome. Again, as people continue to drive this value creation, I think they're making smarter decisions and making the right upfront investment to say it's a go or no go. So we see the trend very positive, and we're excited for it.
Hillary?
Yeah, I'd say more of the same. To your point, I think strategics, you'll start to see a lot more of them that are cash rich, either making acquisitions earlier, which means it's great for us as an exit. Also, it's competition for us as we look to buy into companies. So I think that's a little bit of a dynamic you'll start to see. But more than that, I think specifically with technology, we're going to have a lot more discussions around self-driving cars, robotics in the home, AR, AI, Internet of Things, and that's going to drive manufacturing. It's going to be a dialogue, even as jobs might return to the US. Some of those jobs will be replaced or disintermediated by technology. So it's going to be an interesting conversation.
And Steve?
I think it's going to be a fascinating year. I think it's going to build off of 2016, and I think the technology play is going to be really interesting to watch. We had kind of a discussion before we met here about the different technologies for the home, like the Echo and the other piece that it's just going to get better and better.
Yeah.
What a great way to end on. It's going to get better and better. I have to sum it up there. And I want to thank you all for joining me for a very lively and interesting discussion. Thank you for watching as well. And we want to, again, thank our guest today, Steve Cumbo, Operating Partner at Sentinel Capital Partners, Hillary Gosher, Managing Director, Insight Venture Partners, and also Brian Patira, Principal Transaction Services at Grant Thornton. I'm Rhonda Schaffler for The Deal.